I'm Chris Preston.
I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network, which has been delivering investment advice for 55 years. Brad, the we I think we had intended on this week a year ago, Friday before Oscars Sunday. I think we did the Streeties, the first annual Streeties last year, where you and I wore ridiculous outfits. I think I had a bow tie on. Maybe did you too? I can't remember.
I
Maybe
just
you
had a
look.
s-
I think you look
I
uh,
just had a suit. I
more
don't know about
traditionally
that.
dressed than I was. Yeah. But we scrapped that this week because we have a special guest today we're going to tell you about in just a few minutes. But it'd be remiss if I didn't touch on him. I want to ask you this question because and maybe Madison can weigh in too. Perfect person to weigh in on the Oscars themselves. I'm going to name the 10 movies that are nominated. Tell me how many of these. I think I know the answer. How many of these you've actually seen nominated for Best Picture?
Okay.
Amelia Perez. I'm Still Here. Stop me when you've seen one of these. Honora, A Complete Unknown, which is the uh,
The Bob
Bob
Dylan
Dylan
biopic.
biopic with Timothy Chalamet. The Substance with Demi Moore. It's supposed to be, I think, a body horror movie. It's sort of crazy. It was nominated. The Brutalist. I believe it was a 3.5 hour period piece with a 15-minute built-in intermission. Conclave. It's a good bunch of guys electing the next pope. Nickel Boys, and then these are the two where you may have seen Dune Part Two and Wicked.
Okay. I have
So,
seen The Substance.
you saw The Substance.
Yeah, Substance was interesting. It
I've
was
heard it's
good.
disgusting, is what I've heard. But
I think
interesting, yes.
it was run of the mill. I mean, it's not Terrifier levels, so it's not right like
Yeah,
lazy
so you're
tech.
the wrong person to ask
My
about
my
this.
bar for that is pretty high.
Yeah,
And I saw Dune Part Two. I want to see The Brutalist. I heard it was a really
I
well
do
made
want to see.
film. Did not see Wicked. I have no
I took my
particular.
kids to that. They loved it. Not too
Um,
bad. It wasn't too bad.
I'm sure I'll catch it on like Disney Plus, but I don't know. I was fully prepared once you started that list to have not seen any because I had
That's what
not
I
seen the
thought.
announcement. But no, The Substance and Dune Part Two. Um,
Yeah, I've seen Dune Part Two and Wicked, so two also. Madison, have you seen any of those?
I actually have seen zero of them.
Wow.
I know.
I thought maybe you might have seen Wicked, but
Wicked.
your
I
kid's not
know.
old enough
As
for
soon as
that.
you said that, I'm like, they assumed I saw Wicked. I did not. I'm not that obsessed with. I mean, I like musicals. It was a musical, right?
It is a musical.
Yeah,
Yeah.
musicals are fine. I just didn't. Here's the thing with having a 1.5-year-old. If I get 2 to 3 hours to
Yeah.
myself or alone with Sam, it's not to go sit in a movie theater. So movies are
Yeah.
just
yeah,
season right now.
You're in the movie
I
blind spot age. Yeah, I think, yeah, 7, 8 years, 7 to 10 years ago, I probably all the movies made during that time. I don't think I've ever seen, or at least maybe I'm just catching up on them.
you hit so close to home with that. I remember exactly that same sentiment where it's like, oh my God, we finally have 3 hours to ourselves. Why would we go sit in a movie theater? We can sit at home in the dark with the kid upstairs or, in the other room and watch a movie at home. So I feel seen, Mads.
Yeah, that's our life. Last night we were supposed to go putting and our babysitter bailed like last minute. And we were like, well, crap, what are we gonna do? And we sat on the couch and we DoorDashed Mexican and we just talked and we watched a show and it was like the best thing.
Nice. That sounds lovely. Well, anyway, yeah. So that's the Oscars, hosted by Conan O'Brien, who I'm a big fan of. So that's uh, the one reason to watch,
Did,
at least from my perspective. What do you got?
did you see this? I don't know, it's probably 25 years old at this point. His old-timey baseball sketch.
Oh, from forever ago.
Yeah,
Yeah,
25
yeah.
years ago.
Where a
God,
plane
that
flies over.
yeah,
Yeah,
that one stands out. That's comedic genius right
great.
there.
I've always been a fan. So yeah, it should be funny at least, or his part should be. Okay, let's move on to stocks. Tell people what we're going to talk about today and our
All right.
guest.
Yeah, we are going to talk about the sell-off and growth stocks. We are going to talk about Nvidia's earnings and what they've done since. And then we are going to have a little bit of a conversation about Tesla. But the main event this week, we have Miss Schneider of Market Gauge joining us for what promises to be a really interesting conversation about inflation, markets, how she trades. Highly encourage you to stick around for that one.
Yeah, lots of topics that we don't ordinarily get into are really insightful. Um, but yeah, first, so no defend the take this week, as you mentioned, just for, to save a bit of time. Let's get into what's happening in the market in the last week to 10 days. Implosion, basically, though today
Yep.
looks a little better. Uh, Man, I think I'm going to pat myself on the back for I think my defend the take last week is that the market would be down at least 5%. Um, After it had been in sort of a narrow trading range for a month, and it happened almost immediately. S&P, I don't think it's quite gotten to 5%. NASDAQ, 7% in just the last week plus. There have been growth stock blowups everywhere, especially on earnings. NVIDIA, and we're seeing like the blowups on strong earnings. NVIDIA, Duolingo, both of which reported pretty strong earnings. I mean, the bar is high for NVIDIA,
Yeah.
but both imploded. Palantir down more than 30%. Rocket Lab. Um, there's a bunch of others. I know you have the full hit list, but um, it's been a real change in character for the market. Sentiment is way down, which that part to me is pretty encouraging. What are you seeing, and do you think this is anything more than just a run-of-the-mill correction?
I think it has the potential to be. Um, the We had talked about like looking at stuff that is a marker of the risk tolerance of the market. Um, Bitcoin was one that's down 13% the last 10 days. MicroStrategy down 25%. Uh, we have talked a lot about space. Space is a good sort of metric for risk because it's mostly pre-revenue sort of experimental technology. Rocket Lab down 37% in about the last 10 days. Um, some of these other names like AppLovin was the best performing growth stock, large cap growth stock last year, down 36% off its highs.
Mhm.
Um, the like that's beyond just a correction. That's getting into like re-rate territory. That's sort of like bear market levels for some of these. And obviously with the high flying growth stocks in a true bear market, they're probably losing 60% or 70%. They're probably not losing 30. It's it feels like a shot across the bow. Um, the sentiment thing was like somebody flipped a switch where we went from moderately bad sentiment, people generally kind of bearish, but bearish at a level that felt viable to feeling a little bit panicky. We're seeing the technicals break down, like you said, Nasdaq down 7% in a week plus,
Yep.
S&P about to be down 5%. It's not right. We're not even at the point where we're technically in a correction yet, but we are in a correction in the stocks that were the leading stocks and that were attracting the most like risk-friendly capital. So I'm heavier in cash. I know Mike is heavier in cash.
It's
Um,
72% now, which is the highest it's been in a while.
Yeah, that's the highest it's been since the 2021 peak. That's the last time I think I saw it that high. So that was pre 2022's bear market, which do we get another bear market? I don't know. There's so much headline risk. Valuations are super high. Earnings have been really good, but earnings we talked about it before the earnings what like 3 weeks ago where it's like, oh, it's the best quarter for earnings since Q4 of 2021, which immediately preceded 2022 bear market. So i I do feel like we're maybe more at an inflection point than we're definitely heading lower from here. um I would, like I said, I would be heavier in cash. Keep some dry powder. That way, if we bounce, you've got capital to throw at the names that turn into leaders in like the next leg up. And if we don't bounce, you can sit on cash for a little while and pile into stuff that looks attractive and looks valuable at lower prices.
I mentioned NVIDIA, that's number two in our big three. That blew up after earnings, despite some pretty good Results, EPS 89 cents versus 84.85 expected, up from 49 cents in the fourth quarter a year ago. Revenue improved 78% in the fourth quarter. I think full year was up 114%, 73% gross margin, although that's down about 3 percentage points from a year ago. So the numbers were solid, but Nvidia, as we've talked about, has set the bar so high that it blew up and is down considerably in the last week, bounced back a little, but and so is the market. I don't know that it feels like Nvidia used to be the thing that triggered the market sell-off, and now it's almost it's not a byproduct, but I don't think the market's down because of Nvidia, but I think Nvidia being down is at least contributing to the narrative right now that growth stocks are getting hammered.
Yeah, definitely. And the other thing with Nvidia is it's super big and super liquid. So if you're like an institutional investor and you're saying, "Oh, I'm up 190% in this in the last year and a half," or like whatever the numbers actually are, I need more cash. It's an easy way to raise cash. It's part of, I think, why people speculated that the China carry trade hit it so hard is
Mhm.
because hey, we've got a, we've got, or not China, sorry, the Japan carry trade, right? So if you're paying back yen, you just need cash to do it immediately. You sell whatever your biggest position is, as much of it as you need to, sort of regardless of the underlying. So I do think that there's a component to it that is that makes it a victim of deteriorating conditions more broadly. Obviously, threats of chip tariffs are worrisome for them, right? Like there's a TSMC factory down the street from my house. They're not producing anything. All our chips are imported. Their margins took, like you said, took a little bit of a hit. They're a little bit softer, but they also guided lower. So I think they guided in the
Yeah.
70 to 71.8% range.
Yep.
We're somewhere thereabouts. That's always quite like they've got monopoly power there. Nobody else can design chips like them or make chips like them, so they can charge whatever they want. And if they're taking a margin hit, that means they are accommodating customers. The other hyperscalers are looking at using their own chips or looking to explore alternatives. And, the biggest risk is their revenues are entirely dependent upon hyperscaler spending. Meta, Microsoft, Amazon, Google, right? If those four companies, if one of them blinks and says, you know what, we're not making any money from AI, which is still the case, these companies are not generating revenues from AI as a service. OpenAI lost $5 billion last year. They spent 8 billion to lose 5 billion, and that's including getting a sweetheart deal on some of their compute costs through Microsoft, because Microsoft, as part of their acquisition or partial acquisition, they paid them in like compute credits. Um, if one of the big hyperscalers blinks and says, okay, well, we're going to actually slow down capital spending, which they have not done. They have said, we're going to keep CapEx spending really high. But if that changes, that's like 25% of your buyers just falling off. And if then that becomes a sign of what's to come with the others, or if it's a permission slip for the others to stop spending as much on CapEx, then it's Nvidia takes a major, major hit to their revenues. They can't recoup this money by selling more graphics cards for home PCs for video game players, right? If they don't have the huge data centers that are all using the GPUs, they cannot sustain this. So I do think that there's a little writing on the wall, or at least there's a fair warning of what could go wrong. And I think part of it is people are like, all right, well, I've had a really good run with this. I don't want to wait for that first domino to fall.
Yeah. I mean, I'm sure Nvidia will bounce back. Is its greatest, period of growth in the rearview mirror? Probably. I mean,
Yeah.
people on Nvidia now held on for the next 5 years. I think you'd probably do more than fine. But I think it's entered, the Apple Amazon zone where like it's it's a premier growth stock. It's a good growth stock, that would be just fine in anyone's portfolio, but it's not. You've likely missed the huge profit portion of the run up, or life-changing profit portion of the run up. Um, Barring something, it's not the type of stock you want to count out. I'm certainly not counting it out, but I don't think, just like I said, it's not Nvidia's market anymore. I think there's a reason for that. I think that as the AI fervor is still there, but it's fizzled a bit. It's not the excitement isn't there, I guess, is the way I would put it. And this earnings report sort of validates that a little bit.
Yeah, the bloom is off the rose a bit, and I think we're on like we're now entering our third cycle, our third hype cycle with Nvidia.
Hmm.
A couple of years ago, it was crypto mining. Then it became large language models. Now that DeepSeek as a competitor is out there, it's becoming inference training, which is basically the large language models stop. They generate a response and then they stop and they reconsider their response. Um, and Jensen Huang in the earnings report said, "Oh, that requires a lot more compute," which is true, but it also means that your large language models are more expensive. They take longer to produce answers, um, and it is at least making me wonder. And like whatever, I'm an Nvidia skeptic a little bit, right? Well, I'm an
Yeah,
everything
you are.
skeptic a little bit, but Nvidia, I've been pretty vocal about it being maybe overvalued. Um, it does make me wonder if it's like, okay, well, if this isn't the thing, what is the thing? Right? Like, what's the thing that gets Nvidia from 120 to 195? I don't see anything. The four biggest tech companies on the planet are already spending as much money as they feasibly can to buy the Nvidia's chips. I don't see anything that prompts them to produce more revenue. I see a lot of things that maybe prompt them to produce less. So I'm probably not, I'm not buying Nvidia here. I will maybe look at it if it's at $40 a share or 45
Wow.
a share. Because that puts it at pre-split around like 450. And even that is maybe overvalued depending on what the hyperscalers say, but it's too rich for my blood right now.
All right, let's shift from one Mag 7 stock that took a beating after earnings to another, Tesla. It took a beating after another underwhelming earnings report, as we've talked about on here, and have kept on sinking. So here's two things that are true about Tesla right now. The stock is down 28% year to date. The stock is up 41% in the last 6 months, most of that since the election. Um, I've gotten some emails, but so Tesla, as I think I've mentioned on here before, in my stock of the week newsletter, I think it's not only my but Cabot's longest standing position. Tim Lutz, my predecessor, first recommended it in December 2011 on Mike Santolo, who's a frequent guest on Street Check. His recommendation, Cabot Top 10 Trader, and it's still in the portfolio and made a lot of people rich, a lot of our subscribers rich. Uh, 14,000 plus percent now, or give or take. And been getting for the first time since I've run this newsletter. I've gotten some emails from people like, "What do we do with Tesla now? Do we sell it? Do we get rid of it?" Um, I'm inclined not to do that. I Every time Tesla gets knocked back, and they've had plenty of catastrophic drops over the last 5 to 10 years, more in the last 5 years. 2021, end of 2021, it was over 400 a share. And by beginning of 2023, it was all the way down to 113 a share. Um, got back up to 281 a share by summer 2023, down to 147 a share by last spring, last April. And then, from there, got to new all-time highs just in the last few months. got to 463 a share in mid-December. Sorry, 479 a share, for roughly 480 a share. Now it's down to two in the 280s. That's quite a drop. I, for one, am betting on a Tesla bounce back, but there's some baggage there with Elon Musk's involvement in the government. I think, that has turned some people off. I also think that three out of four, the last 4 quarters have been pretty underwhelming in terms of sales. Um, Musk's penchant for overpromising and under-delivering lately, with autonomous driving features, AI, robots. None of that's really come to fruition, and people are like, all right, show us something tangible. And right now, it's taken on water, but I'm inclined to buy at these levels. What say you? I think I know. I think you are giving the NVIDIA treatment, right?
So it depends, right? If I'm a long-term holder, I think this is probably an opportunity to draw a line in the sand, like stop level wise, and say, all right, I have had the stock since 2011. I've made a fortune on it. This is my price point. If it dips below that, okay, I'm out, and then I'll see where it bottoms, and then maybe I re-enter. And if it keeps running up, great. Like, I don't think you necessarily have to wholesale sell, especially if you're sitting on a ton of profit. Largely, the bull case in my head for Tesla coming into this year was he gets sweetheart handshake deals from the new administration. FCC automatic or just immediately green lights all of like SpaceX's satellite broadband, whatever, like broadband channels, and then NASA starts shipping more business. So it's like, oh, and like Tesla power walls, right? They start using those for like institutional level battery storage for power, right? Like there was a universe in which all of sort of the Green New Deal policies of the Biden administration get carried forward, but just in a way that enriches people that are close to the administration. In that case, I think Tesla looks great, right? You deregulate autonomous driving, that becomes widely available. There's a very clear sort of bull narrative there that just hasn't materialized at all.
No.
Instead, what we're seeing is U.S. consumers are boycotting Tesla. At this point, I probably wouldn't ever buy a Tesla. We have an EV. I like it a lot. It's built well. My brother has a Tesla. He's sort of middling on it. I don't super love them, but there's plenty of people that are going to take a firmer stance and will never buy it. Europe, Tesla sales are cratering. Totally unrelated Tesla relative to Tesla itself, but BYD is eating their lunch in China, right?
Absolutely.
That growth market does not exist for Tesla. Much of the rest of the globe, they're not going to be able to compete with BYD on price. If BYD is shipping a car for $9,600 to Brazil, South America, parts of Africa, right? Tesla is not going to command that kind of luxury premium anymore.
Yeah. And BYD
Right?
not being in America during this tariff, era of high tariffs was an advantage, actually.
100%. Yeah. They get to avoid any kind of retaliatory tariffs from home countries. If we start putting tariffs on like Venezuelan oil, right? Or like, I don't know exactly what, I'm just throwing that out as an example. Tesla gets a reciprocal tariff on them. BYD does not. The big thing with Tesla for me that really scares me, right? Valuation. They traded 144 times trailing earnings. Market cap's right around $1 trillion. I think it's probably closer to 900 billion these days. So I did some back of the envelope math. They make $5,300 a car. That's what their net earnings are. There are expected to be sold 16 million cars in the US in 2025. If Tesla sold every single one of those, that would translate to earnings of about $80 billion, which would still put them at 10 times those earnings levels, which is still higher than Ford and GM. And that totally discounts any value from SpaceX, and it discounts any value from any of the AI or Twitter robotics, like all the sort of ancillary businesses. But like as a car company, if it was the only car company in the US and all they did was sell cars, they would still be valued over Ford and GM, even if they were responsible for every single sale in the US, right? Like that's the thing that has always had me concerned about Tesla is that they don't trade like a car company, but they report earnings like a car company. They report deliveries like a car company. They treat shareholders like they're investors in a car company, but the price doesn't act like it. And yeah, I have probably missed out on massive gains by taking that stance with Tesla, but that's sort of my speed.
Yeah, I think, all that's logical, but, valuation hasn't ever really mattered with Tesla. Um, it's not a traditional car company, even though, like you said, they report, deliveries and, you know, sales and production like any normal car company would. Um, I think it does need to start delivering on some of the promises. And maybe Elon needs to turn his attention back to Tesla a little more than he has lately. I don't know. Um, but I still am going to bet that. So right now it's 288 a share. I would bet that a year from now it'll be higher than that. Again, like we said with NVIDIA, Tesla's greatest period of growth is probably behind it. Although, you would have said that, if we sat here a year ago, when shares were at 200, just over $200, and then spiked to nearly 500 by year's end. That's a pretty significant period of growth. Will we get something like that again? That was obviously a lot of that was election related. So that might have been a bit of a black swan event for the company, but my bet is the share price will be higher a year from now. Will it, more than double like it did last year? Probably not. But I'm not counting it out just yet.
I think it's the poster child for let your winners run,
Hmm.
right? If you've been in it for the long haul, you've been in it even for a couple of years, right? I think it was trading near 100 a share 2 years ago, right? Before the bull market started, maybe 80 or 90 a share. I don't know exactly how low it got.
You got low hundreds. Here, let me pull it up.
So,
Yeah, 113 a share in early 2023.
okay, so 113 a share, that is more than a double in just over a year, or I guess,
Two
closer to
years.
two
Two
years at
years.
this point. So
Yeah.
it's doubled in 2 years. Uh, Line in the sand. What's the price beyond which you would regret not having sold it? Throw your stop in there, and then just let it do whatever it's going to do.
Yep.
Because I'm not betting against it. I'm not opening a put on Tesla or short positions on Tesla. It is
Yep.
unpredictable. Like it's crazy. You don't fight crazy. You sort of leave crazy alone.
Yep.
Um, so I would just say, hey, like if you're a long-term investor, hey, what's the price where I will be happy that I've gotten this much, and even if it runs out afterwards, I won't feel like I've missed out too badly. You just throw a stop in there, and then just leave it alone, and it's gonna do what like we could get a tweet from or a truth from Trump tomorrow saying that Tesla is now the official cell phone provider of the United States and that they've rescinded all of like Verizon's licenses and AT&T's license. Like that's not going to happen, but it's not impossible.
Yeah.
Like
Yeah.
there are
Yeah.
things that could juice Tesla from here. Um, if you
That's what
bought
I'm
it,
betting will happen. But yeah, your point that yeah, it's probably not going to double again this year, I guess and it's already down 28%. But we need to move on to our guest for today, Mish Schneider of Market Gauge, and we'll get to her in just a second. All right, we welcome on Mish Schneider of Market Gauge, Chief Strategist of Market Gauge. She has just put out recently Market Outlook for 2025, it includes top 10 picks that's on the marketgauge.com website. Mish, welcome. Thanks for joining us. Lots to talk about in the market right now. So we'll get to as much of it as we can. Talk a little bit about, your sort of your investing style and background and your approach to things.
Okay, well, first of all, it's great to see you again, Chris. We got a chance to meet on the Money Show top picks this year, so
That's
that
right.
was fun. And thanks for having me on today. So, yeah, I mean, I've been in this business a long time, and I started actually as a trader on the Commodities Exchange in New York. And I was there for the hyperinflation moves very young. Granted, but I was there. And so I really got to experience what it's like, first of all, to catch a parabolic move and what it's like when that parabolic move is over. And so
Right.
I think that really was has been my style of trading is that I try to get in as something is emerging, momentum is increasing. Of course, back then, momentum, you could hear it, you could feel it, you could see it, you could taste it. But now momentum is more measured through certain indicators that we have proprietary at market gauge. But nonetheless, the idea is the same, is you get in, the momentum is increasing, you get some kind of a good parabolic move. And even if not a parabolic move, if you get a good move, let's say 2 or 3 times what your initial risk was, you take profits, you have trailing stops. And this way you never go from a parabolic move to a major loss, which is something I think a lot of people have experienced over the last week in the market. So that
Mhm.
cut my teeth. And I love commodities. Obviously, I had to spend a long time waiting for them to pop up again, but COVID kind of brought them back to life. And so that's that. But I also trade a lot of stocks. I try to keep to a theme, which again would be more of a sort of a commodities market mentality, which is whatever was hot in the commodities market is what you traded. And if it weren't hot, you didn't go near it.
Right. And you have something you call an economic modern family. Talk a little bit about what that is and what you look for there.
Well, I do have a master's in special education. So I did start out life in special education. And then through the years, I've done inclusion consulting in school districts, which means basically I'm modifying curriculum, general education curriculum, to make it accessible for kids who have all different types of disabilities. So that's kind of how I think. And when I started in the whole stock space, which really was right after the crash of 2008, is when I got started. I needed a way to explain to myself the mechanism of the U.S. markets and the economy, and so I started to think about them as a family with visuals. So I actually have cartoon characters and dolls that represent these sectors. So they would be small caps as the granddaddy, and as we know, even though we've seen growth dominate, small caps ultimately rule, particularly in this administration because there's so much emphasis on what's happening in the US. Then retail, of course, is 70% of the GDP. That would
Yep.
be granny retail. And actually, and I say she, but she kind of gave me the clue that we were going to have this sort of big correction that we've had. And then it sort of wraps up with transportation, semiconductors, biotechnology, regional banks, and my newest member would be crypto.
Who is
Interesting.
crypto in the modern family?
So crypto is the tween,
All right.
kind of like at this age,
I have
it's
one of
not. Yeah,
those.
you have a tween. So
Yeah.
they don't really they can be volatile
Yes. Yeah.
and their hormones are raging and they don't really know what they want to be yet when they grow up. And that's kind of I think a really good metaphor. My cartoon character of crypto is kind of like millennial looking with the man bun, smoking a doob, because and with I
Yeah.
try to make them amusing and memorable. And yes, a little bit stereotypical, but that's how you remember things, right?
Right. Uh, Brad, go ahead.
So I want to go back just because like this really stood out to me. You said you came up essentially when inflation was raging, and that is obviously like one of the biggest fears on the street right now is that inflation's going to creep back up, tariffs are inflationary, excess spending inflationary. So how are you playing it right now?
Well, again, I'm a very linear thinker, right? That's why the family emerged, and the same thing with inflation, because what I noted back in the day were there were really what I call the trifecta of inflation. So number one would be the silver to gold ratio. So even though we've been buying gold, and I've been calling out gold for 3 years as a great buy, really what I think that's been more flight to safety, what would make it more of an inflationary play would be if silver starts to outperform, which back in the day, that's exactly what happened. The ratio right now is where gold is about 90 times the price of silver. In 1980, it went to only 17 times the price of silver. So there was your flip. And I think if that ratio breaks down under 80, that would be indicator number one that we're going into a higher inflation. Number two would be the dollar. So the dollar broke down, but not really. It hasn't really crashed. It's just been more in a range to me than anything else. But back in the 1970, 1980, obviously purchasing power went way down. And the third, believe it or not, was sugar futures. And that's something that most people don't really think about. But I learned back on the floor in those days that sugar actually rallied before the gold and the silver, and then even in 1980, the sugar rallied again, went from like 3 cents a pound to 45 cents a pound. And what does that mean? Yeah, there could be weather issues, of course, with crops, but it's usually something that is in everything. So it's like a staple, global staple that people will hoard in tough times, and in inflationary times they'll reach for things like that as opposed to whole foods, for example. So if you put all those together, that's really, I think, a great picture. And to date, even though we're seeing inflation and it's been nuanced, are not really seeing the at this point the 1979 1980 narrative setup. It doesn't mean it won't happen. And certainly we're seeing inflation in areas, but at this point right now, it's all conjecture that it's going to get much worse.
Can
Yeah,
I ask just one clarifying question on sugar futures? Given that the prevalence, at least domestically, is now high fructose corn syrup, should we be looking maybe at corn futures as a proxy or substitute for that?
Well, I'd say yes and no, because again, you're thinking about it with American eyes, but
Sure.
yet, a couple of years ago after COVID, in some African nations, there were literally fights breaking out in supermarkets over a pound of sugar. So I think you have to look at it globally, number one. And number two is, yeah, we're all very health conscious, and of course, we're going to get into the whole vanity trade that I'm calling with diet drugs, and etc. But the point is that it's still what people, it's in everything. Maybe not in the way of corn syrup as much, although it still exists, but it's really like if you pick up anything, a can of anything, or a box of frozen food, and you look at the ingredients, sugar's in there. So it hasn't quite become the devil that people would like it to be. And as you're sipping, what are you sipping right there? Is it sugar
Uh,
free?
yeah, seltzer water.
Oh,
No
there
sugar.
you go. So no sugar
I
in it.
swear I was just taking a drink. I was not trying to be like prove a counterpoint or something.
No, it just the
Good comic
timing
timing.
was interesting. All right. Anyway, I hope that clarifies. But yeah, to your point, Brad, corn and wheat and soybeans also really important, no doubt about it. And corn took off, wheat took off, and soybeans took off, but they've all come down a little bit, which is why I say the big inflation narrative at this point is more conjecture, and we haven't really seen it in the price.
Yeah, so that was what my next question is. So what's your concern level about, inflation worsening? Sounds like maybe not terribly high.
Well, a lot of this recent talk of inflation going to a much higher level. Well, first of all, let's face it. We know that inflation has increased. We saw CPI sort of flatten and has been inclining. The PCE numbers that came out on Friday, showed consumption is down, but prices are still up and wages were up. I mean, there's all these different signs that anything could happen. Deglobalization in and of itself is inflationary. Obviously, we just showed that we're willing to raise the debt ceiling as opposed to lower it. We're still doing a lot of spending. All these things can come back and haunt us for higher inflation, no doubt. And of course, the tariffs in and of themselves. But at this point, I still have to see it in the price. And that's why I use that trifecta. That doesn't mean I don't think silver can go higher, gold can go higher, sugar can go higher. Oil would be a next factor. That could even go higher. But at this point, it hasn't gotten to the point where I'm ready to wave the flag of, fasten your seatbelts because here comes hyperinflation. All we're seeing now is a rising tide and a lot of fear.
Right.
So are you
Um,
just, if you see that the silver gold ratio dip below A or gold silver ratio dip below 80, are you just immediately hitting buy on silver, or is there a specific play that you're looking at?
Well, I would certainly be buying silver. I'm already been buying silver since it was trading at $20. And same thing with gold since it's been trading at 1500. But I'm also doing commodities trading mentality. I'm taking profits on the way up and then waiting for dips to look like they're buyable dips. I might change that to chasing rallies. See, right now, every time silver looks great, it sells off. Every time it
Yeah.
looks terrible, it's a buy. That when that changes, when it goes, orange juice futures or cocoa futures or coffee futures crazy, which we saw all three of those go nuts. That's when you keep adding. That's that compounding mentality that happened on the commodities exchange when something goes parabolic.
What are some other mega trends or sectors that you really like right now?
Well, I think what has really saved me from losing my mind this year as a trader and watching these massive corrections is to think thematically and then stick to those themes. So, a lot of people came into this year thinking that we'd see a market broadening and that we would see more value plays. And we've seen a bit of that, not enough yet. That doesn't mean it won't happen, but clearly the sell-off has hurt that a bit. So in that thematic trading, what am I looking for? Well, definitely one would be watching that trifecta of inflation that I was talking about. But secondly, with everybody that ran into AI and tech, I'm looking at more of what hasn't really happened yet that's more futuristic, that has a really good solid base. So robotics would be one. And we've been this area of anywhere from 22 to $24, let's say in a stock like Symbotic, which is probably the premier robotic company. It's expensive, it takes time to install, but in terms of fulfillment and efficiency in warehouse, it can save a company like Walmart, who uses it, millions and millions of dollars. I think that's a future. I think that quantum computing, I mean, Amazon has been talking about it now. Lately, it's been headlines. I think that's a future that first was doing great, and then Jensen Huang said, oh, no, we're 15, 20 years away. And then Bill Gates came out and said, no, we're really only more like 5 years away. But no, regardless, these prices are cheap down here. Um, and then the emerging markets would be another, where obviously China turned out to be a great trade. I'm looking at Vietnam. And then I think the final, and I won't say final because I'm always open to new things, but I've really been keen, and I think this is a mega trend in infancy, on what I'm calling the vanity trade, which is really the domino effect of these diet drugs and
Hmm.
what changes we have in the consumer as a result. So you have to be looking at skincare and beauty and, AbbVie, which was my top pick, by the way, on the Money Show.
Yep.
While this market has been selling off, that thing has been rocking and rolling. In fact, right now it's trading up at 20, almost 206. I mean, I think that reflects it. Partly immunology in that company, but also they do Botox. So you have to look at like Nike and fitness and stay away from things. Back to your sugar point, Brad, because they're starting to move away from eating fast food and eating junk food. People who are on these diet drugs, and it's growing. And the
Yeah.
announcement this week that Eli Lilly is coming out with a cheaper version of the diet drugs, and also building four plants in the US, spending, I think, something like $27 billion, which brings me to my final theme, which is made in the USA. All of that, I think, is something to keep an eye on. How these consumers who are now thin and going to stay thin spend money.
That it's very interesting that you bring up the vanity trade. We were fading alcohol specifically. Was that last year, Chris?
Yeah, I
Um,
think
I
so.
think last year, just seeing like millennial consumption trends specifically, and I think that goes hand in hand with exactly what you're talking about, which is, the wellness prioritization. And it's like, okay, well, probably Coke and Pepsi are going to keep paying dividends, and they'll probably keep doing fine. But I think there's room to fade some of those names.
I totally agree. And so I don't necessarily look at what I can sell as a short, but more what I can look to buy that has been, again, hinging on the lows. I mean, let's take a silly stock. I say silly, but it's a huge company. And you hear it all the time on social media, but Match.com. it's gotten beaten up. That's another classic stock that's gotten really beaten up. Now, I don't have a position in it, but it's something I'm watching because, again, it seems to be basing between, let's say, $30 and $34 a share. And if you're losing weight after, especially after being home, and we know that obesity has been a huge problem in this country, if you all of a sudden want to go out and finally date because you feel good about yourself, Match has Tinder. And as far as I know, listen, I've been married for a long time, but as far as I know from my single friends, those are still the hot places you go if you're looking to hook up.
Yep.
So I would watch something like that too.
Shifting back to sort of the what's happened in the market in the last week plus, growth stocks in particular gotten beaten up, and sentiment is really dipped. Consumer sentiment, but also just sentiment among investors. AAII is showing that fear is pretty high right now. Do you see that as a contrarian play, or great time to buy now that sentiment has gotten this negative?
Well, yeah, let's put some price narrative on that. So one of the most interesting things happening in the market right now is we like to measure risk from the viewpoint of the long bonds versus SPY and the long bonds versus junk bonds. And both of those indicators are showing long bonds right now outperforming both the S&P 500 and the junk bonds, which is risk off, except junk bonds are sitting really high right now. So there's your anomaly. Obviously, there is still a huge appetite for high yield, high risk debt, right? Companies that don't have good balance sheets, but the bond traders are willing to be in them because of the big payoff. So that's telling me that the fears of, let's say, a credit default or even a major recession right now are more fear than reality. So I think that that could be the contrarian play, just like extreme exuberance was obviously the contrarian play to start cashing out or taking profits or even going short if you were so inclined.
Right. Yeah. No, I like that perspective. Brad, do you have one last thing?
Yeah, I'm curious, is there a case to be made that that junk bonds are maybe just a money supply play, right? Like if we're going to keep pushing up uh federal deficit level, or you know outstanding federal debt, that money has to go somewhere. Treasuries are getting that a little bit of a maybe flight to safety-ish
Hmm.
uh impetus behind them right now, but I wonder if maybe if people are moving out of equities, if junk bonds becomes like the next tier down on risk.
Well, from a historical standpoint, I would think that that would be a little bit scary to be piling into, companies that have terrible balance
Yeah.
sheets but pay high. Because if we have a real recession, those things are going to get killed. So I'm looking at it more from that standpoint. Not so much is that a sign of where people are putting money because it's a safety play, but more that it's a sign that they're taking advantage of the fact that with the yield curve, number one, and number two is that whether or not we don't know yet whether this is an absolute brilliant move on the Trump administration to keep threatening these tariffs higher and higher, which then of course brings EU and China to the negotiating table so that we come into some kind of a trade agreements, which would then be very good for the economy. We don't know that yet. And that of course would avert a lot of problems, number one, and certainly a recession. I like to look at it more that way. If I start to see the junk bonds really sell off, I would get nervous. In January and February of 2020, before COVID was even a headline, the junk bonds were starting to crash. And we liquidated everything and went into bonds back then. Right now, I'm seeing, I would want to see more flight to safety to bonds and less movement in the junk bonds to think that perhaps it's just bond traders piling in because they think that's the next big play. I don't know, but I could be wrong, of course.
Yeah, that's interesting. Well, if you want to read more from Mish and from Market Gauge, we have an offer for exclusively for today's listeners. If you go to cabotwealth.com/street, you can download a report from Market Gauge, get three stocks ready to move now. The report is available for a limited time only, and when you opt in, you get the PDF report and access to a quick video, which you'll discover how to use the three stocks in a way that has beaten the market by 3 times to over 10 times. Build your wealth in your spare time. Leverage market edges that professional hedge funds have used to get ahead for decades and more. Again, go to cabotwealth.com/street to download your free report from Market Gauge. Mish, thanks so much for joining us. It's really great to get an outside perspective, and I like the way you look at things. And there's things we haven't even talked about a whole lot on. We feel like we talk about just about everything in this podcast, and you hit some things that we haven't even gotten into. So thanks for sharing your perspective.
Well, thank you so much. And thanks, Brad. It was nice to meet you as well.
Yep, you as
And
well.
yeah, go check out the offer that we're doing with you guys on for Market Gauge from Cabot. And yeah, and my Outlook 2025, because I
Yeah.
think that'll give you a lot of information on how
Yeah,
I think.
marketgauge.com. You can get what is it, your market outlook for 2025 with the 10 picks. Yeah,
Correct.
right there. Great. Thanks again, Mish, and we'll see you again sometime down the road.
Love that. Thank you so much,
All right.
guys.
Take care.